focused on cloud and colocation, data center industry trends, and dynamic market. Hey, I'm David Liggett with Data Center Hawk, and I'm really excited to be sitting with Jonathan Schildkraut here at CyrusOne's headquarters in Uptown, which is just north of downtown Dallas. Jonathan is the Chief Strategy Officer with CyrusOne, and very excited to be here with you. Thanks for letting us be here.
Oh, thanks, David. I really appreciate you spending the time with us.
You bet. Well, we were just talking about it. You're a couple of days away from being at CyrusOne for 2 years, so an early congratulations. But you know, you've been in the data center industry for a long time, and we knew each other at previous engagements. But when you think about the industry, you know, what are some of your general observations on the industry in itself, and then what eventually led you to CyrusOne?
Well, it's a great question. You know, much like yourself, I've spent a lot of time in this space, probably a good 15, 16 years now in and around the data center space. And, you know, there have been so many changes. We're probably in the third or fourth iteration of this industry. The reason that I decided to move in industry and the reason that I decided to move to CyrusOne is I was observing some major changes in the way that enterprises and other companies were interacting with their IT infrastructure.
Sure.
And I felt that CyrusOne was really, really well positioned for a lot of those changes. And, you know, no doubt cloud has been sort of the key story for us. But the cloud has made two meaningful changes from an industry perspective, which really inure to the benefit of CyrusOne and ultimately to our customers. You know, the first is when you look back historically about the demand curve of deals in the data center space, it was your sort of traditional bell curve of demand. The biggest deals were, you know, financial services, you know, 1 to 3 megawatts in scale. But, you know, there was a good range of deals from the very small to the very large. And what's happened is that as companies more and more outsource the applications, the storage, the compute to cloud providers, it's changed that curve to one that is skew left. And what that means is the industry today is dominated by very large transactions. It's not that there aren't smaller deals out there or enterprise deals, but the industry and overall demand profile is dominated by these very large deals. Now, the implication for somebody like CyrusOne starts with the ability to access some of that demand. Historically, again, if you think about a traditional bell curve, there was a large portion of that bell curve that we could never go after. That is, we didn't have enough salespeople, enough customer service people to go out and serve all of these SMB deals. And now what happens is those SMB deals don't go to co-location providers, but more of their resources end up on the cloud, and the cloud ends up as a demand aggregator. And in turn, that's an opportunity that we can actually prosecute. But the other part is that there is a change in the way that data centers are sort of observed from a customer perspective. Again, think back to when we started in this industry. The data center was the destination for your IT resources, right? This was your fortress. It was your warehouse, right? Where you kept everything. And so you wanted the walls to be as high and the moat to be wide and deep as you could possibly imagine, right? And the industry asked for very high resiliency, et cetera, at the time. And what's happened is our data centers are they're still a destination, but they're not the final destination. That is, more and more our customers are shifting to these hyperscale customers. It's probably about 35% of our business today, but it's good 70-75% of our growth. And that goes for the industry as well. And when you think about it, those customers are using our data centers for a different purpose. Again, we're not the destination for their IT, but we're actually part of a platform for them to deliver their services to their end users. And so we've gone from this destination for these customers to being part of a global logistical fabric for service delivery. At the same time, enterprises who come to us, yes, they want to store some of their own equipment, private cloud, other resources inside our data centers, but they're also looking to us to make sure that they can stitch together that hybrid multi-cloud fabric that they need. That is, they have a number of resources they need to be successful. And so we also have to be able to help them get to those critical resources.
Yeah, you know, and I think it speaks to, you know, as the data center user has matured, the way they utilize their application delivery is much different today than it was in the past. And so I think, in my opinion, you know, CyrusOne has changed to better facilitate that. But, you know, and I know we've talked before about speed being so important, but speed and what else do you see as the advantages that CyrusOne has kind of built within the company to help deliver the infrastructure at the rate it needs to be?
Well, look, I think speed is critically important. It's obviously one of the things that we talk about a lot. And speed matters for sort of a number of reasons, but probably one that's really important from a customer perspective, and the other that's really important from a company and investor perspective. So from a customer perspective, again, we're really dealing with more and more of these large hyperscale customers. And when you think about their revenue growth trajectory, the numbers are really staggering. Sure. It's not just how big they are and how fast they're growing, but the consistency of the growth and what seems to be a very long growth profile. And the thing that's really amazing about these customers is while they have a pretty good sense as to how much growth they're going to have, they don't necessarily know where that growth is going to materialize.
Okay.
And so for us, the ability to deliver capacity in short order in almost any market becomes a very important selling tool for these customers. And they can rely more and more on the industry to deliver that capacity rather than making very large scale commitments in any particular market. But the other piece, and the piece that I think is often overlooked, particularly by the investment community, is about risk. That is, so much of our focus in the chatter in the industry is from an investment perspective, at least, is about what your returns are. And taking a step back, when you deploy capital, capital demands a certain return. The higher the risk that you take on, the better the return has to be to justify taking on that risk. And what speed does is it changes the dynamic. That is, if you could only deploy a small portion of your capital in advance, you buy a piece of land, maybe you put up the shell, you get it permitted, maybe this is anywhere from 5 to 15% of your total capital spend, but you're able to collapse the speed to deploying the rest of the capital, it means that you can win contracts and deploy capital afterwards. And when you deploy capital with a contract in hand, the risk profile is remarkably different. And so for us, as we take on these bigger and bigger customers that demand and command better and better rates from us, the way that we are able to keep our risk-adjusted returns steady is by reducing risk. And speed is a huge risk reducer for us.
Yeah, sure. No, that makes a lot of sense. And it's I think one of the ways that your company and obviously others are looking to lead in that part of the market. Another thing that you all have done, I think you were personally involved in some of the international expansion that's taken place with CyrusOne. And as we think about the market, we certainly believe that growth will continue to happen in the United States. But if you look in some of the larger European markets, I think there's a lot that will happen over there in the next several years. But talk about that process and why expanding internationally in the way that you all did was so important for CyrusOne.
All right, wow, this is a big topic and one that I'm excited to talk to you about. So great question and thank you. So the primary reason that I was hired was to help us build an international or a global platform. And so we have spent the majority of the time that I'm here really focused on that. And what I tell you is when we took a step back, what we did was first thing, and really anybody should do this, is we examined our own core competencies to make sure that we were going to pursue opportunities which we had the best opportunity to be successful. Our core competencies at the end of the day are building at scale, so time, that's the speed element, but cost as well. Selling, we represent probably about 17% of reported sector revenue. Over a trailing 12-month base, we're about 30% of reported sector leasing. So we sell more than our weight in terms of the market itself. And we score very high on customer service. Strip it down, build it, sell it, service it, right? So that's where we do really well. And when we went and we looked out across all the markets and market opportunities, what we saw was that rather than demand sort of spilling into secondary and tertiary markets, which is an idea I think we've all talked about for a long time, we've actually seen a concentration of demand to major GDP markets on a global basis. Now, as a real estate company, you ask yourself about portfolio diversification. And so what we decided as a company was that we would be better off creating that diversification by going after A markets on a global basis rather than pressing into B and C markets in the United States. Now, when we went and talked to our customers about that as an idea, we saw a significant amount of demand saying, help me in this market, this market, this market on a global basis. Now, why is it so critical for us to then be in all of these markets? And then we'll talk a little bit about the deals themselves. Well, the first and foremost is when you think about what we've done and a lot of our peers have done very successfully is really to manage the hell out of the supply chain, right? So what do? We really focus on narrowing down to a couple of suppliers. We tell them that they're going to get our business, and in exchange, we're able to squeeze that supply chain to get better pricing on equipment, services, etc. Now, when you think about the dynamic that we talked about the earlier part of this conversation about these cloud companies being demand aggregators and ultimately driving more and more of the demand in the market, we expect the same behavior from them as it relates to us as we've done to our vendors, right? Choose a few vendors, squeeze them, and then ultimately work with those providers. And when you think about that dynamic, if you want to be on the right side of that vendor consolidation, then you need to be in the markets in which these customers need to be. And that is a global marketplace. And so that was another reason underpinning our move to go global. Now, going international has been a tremendous experience, I think, for our company. And to your point about demand in general, where we're seeing sort of the global market do really well, we've absolutely seen times where US market is good or Virginia is good or Phoenix is good. And when you have more markets on a global basis, if Virginia isn't as good this year, and I think I've seen some of your first quarter numbers, this is going to be a more balanced year probably in the United States than last year. Well, we might see a very strong year in Europe or in Asia. And so we're able to maintain our growth trajectory while having sort of more chips on the table, which is critically important for us. And when you think about what we've done over the last, call it 20 or 24 months, is we've added 3 continents, 7 countries, and 12 different markets where we could satiate customer demand. The first deal, as you know, was to help us press into China, help our customers there. We made an investment into GDS, the leading provider in China. That investment also tapped us into hyperscale demand out of China. And when you think about it, today there are really only 2 origin countries on the planet for hyperscale demand, the US and China, and this gave us a direct pipe into both. And we've seen a tremendous success around that. We got about 20 megawatts of deals coming from China into the US. We've helped some of our customers into what is a very difficult market to make their way into.
You bet.
Then we bought Xenium. Xenium was our land and expand strategy into Europe. And the idea here was get a speed to market advantage through the acquisition and acquire significant management talent. And when you think about those components, there was tremendous amount of operating leverage. So we bought basically 4 buildings and 50 megawatts of capacity. Today, and that was in 2 markets, today we have, heading towards 10, 11 buildings, but really we're looking at 4 markets, so Dublin, the UK, Frankfurt, and Amsterdam, and 225 to 250 megawatts of capacity, excluding what we're doing up in Middenmeer, which is in the northern part of the Netherlands. So we're taking that same team and using that team to operate many more markets. And so we're going to get a ton of operating leverage out of there. And that was an acquisition coupled with some organic growth. And then the third deal that we did was a joint venture into the Latin American markets. And there we were just seeing early stage demand, not only from our US customers as they wanted to get into Latin America, but also what we saw was signs of some of the Chinese hyperscalers having a desire to build into those markets. We found a fantastic partner in Patria, which is a private equity firm, and we did a joint venture around a company called OData, which had operations in both Brazil and Colombia, but really has plans to create a pan-Latin American footprint. So again, when you think about where we were, a US-based organization 2 years ago, and now we are a largely global organization. That doesn't mean we don't have holes to fill. I've got a busy couple of years ahead of me, but we've made tremendous progress in a short period of time.
Well, you had a busy couple of years behind you too, it sounds like. And I think it speaks to the trend that to an extent this is really becoming a global business. I mean, customers in the US have global requirements, and I think they're pressing companies that they work with to really help solve their problems on a global basis. And so I think it speaks for sure to some of the things that you're doing. As you have expanded, how have y'all seen some of the data sovereignty challenges in different markets impact the way you all do business and the way you're just thinking about your business, as well as customers that you serve in those markets? How have you seen that impact those opportunities?
Well, look, the only place we've really seen, I think, meaningful sort of progress on data sovereignty would be Europe to date. But Europe is probably a fairly good blueprint for what the world is going to look like. At the end of the day, what it means is that more data needs to be stored within the sort of boundaries of a specific country. And so when you think about Europe, we think it'll be a more distributed demand profile over time. And that creates, a fairly significant opportunity in a lot of different places. Today, we are focused on the largest GDP markets in Europe. We're in 4. We'll probably have to go to a couple more over time. And then you're also going to deal with the same issues on a global basis. I think, though, it's probably a bigger challenge for our customers than it is for us. Because ultimately, it's about who's managing that data, who has access to that data, and being focused at the physical asset layer sort of keeps us out of the fray. So in a positive way, we think it helps demand. And in another way, we're able to avoid some of the more sort of stickier situations around data privacy, data sovereignty that our customers have to deal with.
Yeah, and a couple of things that I think on the demand side that are coming, this is kind of a futuristic conversation around technologies and how they might change opportunities for data center operators. But, two that we talk about a lot are 5G and the changes with that, as well as artificial intelligence and how that's impacting some of the ways that your customers and customers across the world are utilizing their IT infrastructure to serve what their technologies are. What are your thoughts on those two technologies and how they will impact the infrastructure space moving forward?
Absolutely. First of all, two of my favorite topics. I'm a nerd, so we get a real chance to nerd out right now. So look, when you take a step back and we talk about this transition to cloud that we started our conversation with, that transition to cloud from an architectural perspective is almost a return to a mainframe style architecture. That is, if you go back into the beginning of computer architecture and networking, what you started off with was a very powerful mainframe and dumb terminals that sat around on the edge. And that all really worked primarily over a local access network. Now, networking changes have been a dramatic driver in the ability to deliver cloud, but really, you also had compute changes and some other changes happen as well. So you start off with this mainframe, centralized compute, dumb terminals on the edge. The cost of compute drops down, chips get cheaper and more powerful, storage at the edge, and you end up in a client-server era, right? We all have powerful PCs, and now the compute, the applications, the storage sit at the edge of the network, even though there's a centralized controller. With network improvement, and I think 5G is still just another sort of milestone on a path that we're going from true ubiquitous networking technology, it allows you to take, when you couple it with cloud technology, it allows you to take that mainframe architecture, which lived on a LAN, and take it out on a WAN. And not only just sort of a WAN over a region, but a global WAN. What you're talking about is reducing latency, improving access, improving speeds, improving communication. And so whereas we took centralized compute and pushed it out to the edge, this allows us to take, again, applications, storage, and compute that formerly sat on the edge during our client-server era and bring it back into a cloud-based model. So it really helps the whole cloud dynamic. Now, there's an element of Internet of Things and artificial intelligence which really tie together, and that is 5G will ultimately be part of a platform which aggregates more and more data. And artificial intelligence is all about sort of data creation, capture, and analysis. And on any given day, we're creating something like 2,500 petabits of data, so just absolutely massive amounts of data. we're doubling the world's data every 18 to 24 months.
Yep.
We've all
Yep.
heard it all. And 5G will just be another sort of opening of the funnel to collect that data. And ultimately, artificial intelligence be, able to analyze that data, make better decisions, drive production, better products, customization, things like that. AI, as it stands for a data center operator for us, is truly sort of the gold mine that sits at the end of, or the pot of gold that sits at the end of the rainbow.
Yeah.
So let's take a step back. Over the first 11, 12 years of the cloud has grown to about $100 billion global business. And that has been sort of great growth. Now, we think that you can put about $1 billion of cloud revenue on 20 to 25 megawatts of IT load. It's probably trending to more efficient over time, but every time you get more efficient, the cloud companies slash their prices, and then the amount of revenue they can load onto a megawatt shrinks a little bit. But assuming that there's 20 to 25 is a pretty good number. When you think about the next 5 years, most of the analysts that have numbers out there think the cloud will grow to maybe a $325, $350 billion business. So 11 to 12 years to get to 100 billion, the next 5 years to grow another 225 or 250 billion. At 225 or 250 billion of revenue using our 20 megawatts per $1 billion of revenue, you're still talking about 4.5 gigawatts of demand just from cloud companies. Now, that's probably 70 or 80% of the market. So you have to gross that number up in terms of that global demand profile. Again, think back 10 or 15 years ago, right? Yeah. If the globe did 300 or 350 megawatts of leasing, it was a banner year. Yes. And last year, by our numbers, and we use your numbers and the other folks' numbers out there, we think the globe did north of 800 megawatts of leasing for the first time ever. Sure. And based on the trajectory we're talking about, on cloud alone, we're talking about somewhere between 900 megawatts and call it 1.2 gigawatts of annual demand from the cloud. Okay? Now, the cloud will grow to, say, $350 billion opportunity, which lives inside of a $3.5 trillion global IT spend. According to PwC, according to the other folks who have studied artificial intelligence, the annual value creation of artificial intelligence by 2035 will be between, call it, 14 and 16 trillion dollars. So 4 times the size of the global IT spend, effectively almost as big as the United States GDP. If AI is 10 times more efficient in consuming power than the cloud is, you are still going to have literally doubling, tripling of that demand over time. Let's think about it a little bit differently. Okay, you go back to those early days we were talking about. By our estimates, the industry had to spend somewhere around $6 billion a year of total capital to support all the growth we expected in the industry. Today, as we look out over the next 5 years, right, with that cloud dynamic being the main driver, it's probably $14 to $15 billion a year of annual capital investment from the industry to support the growth of those cloud companies. When you start to look at AI and the numbers we're talking about over AI over time, now you're talking about $25 billion a year of capital investment from this industry to support that. And again, that assumes that AI is 10 times more efficient than cloud in consuming power as a critical resource. So for folks like us, there's a huge opportunity in serving these customers. And for investors, there's a huge opportunity in value creation and participating in that value creation.
Yeah, and it's one of the reasons I think from my perspective, you've seen the data center operator community make sure they are positioning themselves to handle that growth in the United States, in Europe, in other markets as well, because we certainly have seen that over the last several years. When you think about if you think about demand, U.S. demand in the last several years, and you take the hyperscale operators kind of out of the game, you're left with the enterprise user community. Traditionally, Fortune 1000 companies. What kind of changes are you seeing from them and the way they approach the market today? Obviously, we see different hybrid strategies as they look to really get efficient with their applications and with their infrastructure set up. But what are you all seeing as they look at the market?
Well, look, I'll start with the premise that I agree with you. They're changing. I'd say there are a couple of changes that are really meaningful for folks to understand. Certainly, one of those changes is that enterprise ultimately will be using what we think is a hybrid multi-cloud environment. I think that has become somewhat accepted over time. If you go back to some of the big industry conferences 5-7 years ago, they'd say, oh, everybody will use 2 to 3 clouds, and then RightScale came out and said, oh, we think it's going to be 6 to 7, and the number seems to be going up and going up. And that is because more and more of these clouds are becoming application specific, right? So my CRM is run on Salesforce, my Office Productivity Suite is on Azure, my financial package and databases with Oracle, my storage is on Amazon, whatever it is, they're pushing an application-specific workload onto a different cloud. And so more and more it becomes critical for us to help those customers put together the fabric that they need to be successful. A big part of that, in something that I know that you talk about, is software-defined networking.
Sure.
And software-defined networking, in its very simplest terms, is the ability to apply a cloud-like demand and pricing model to a network capability. And that is a huge opportunity for enterprises. And when you look out at software-defined networking versus some of the other potential topologies that enterprises could deploy, software-defined networking has a number of advantages. And they go from cost really to simplicity of management. And that is, I think that the idea that you are going to go from a single enterprise to a single cloud, that starts to disappear. And when you start to think about connecting into multi-clouds, you might look at maybe an interconnection hub as a way of getting to that. You're still probably going to need to buy a dedicated connection from the enterprise into that interconnection hub, which is a very expensive connection. But if you could reach all of your critical platforms, it probably makes sense. The reality is that not every cloud lives in every interconnection hub. And when you go and deploy that topology, before you know it, you're buying a dedicated connection to 2 or 3 of these interconnection hubs instead of just one, which was really the promise. And so that is expensive in terms of those big connections to the interconnection hub, let alone the cross-connect costs, which tend to be pretty reasonable. There is another challenge, which is that is a complex network management. If you plug into an SDN, then you have one connection to manage. It's also demand driven, so the more you use, the more you pay, or the less you use, the less you pay. So the highway is there when you need it, but you're not paying for it when you don't. And at the same time, you're meaningfully reducing the complexity of network deployment and really of putting these hybrid multi-cloud environments into place. So SDN has been sort of a critical element for enterprise, and for us in particular, Megaport, we're the biggest partner of Megaport in the United States, maybe even on a global basis. And we work with any SDN provider that really wants to come in and serve this customer base. The other part is what does it mean for a provider of space to enterprises over time? And really what we think will happen over time is that the enterprise footprint on average will shrink. That is, if you're taking an application and you're pushing it onto the cloud provider, then really the cloud provider buys the server and then they rent the data center space. And so the amount of data center space each enterprise needs to rent is somewhat smaller than what they needed in the past. That being said, somewhere between 60 and 70% of all enterprise applications are still managed in-house. And we think that this will be a major impetus for enterprises to come out and to use third-party providers. One is that most enterprises who built their data center space overbuilt. I mean, it's something that most of the industry has talked about. And so their sort of overall capital costs and embedded costs are much higher. But as you also understand is as your utilization goes down inside of a data center, your PUEs and your operating costs get really out of whack. And so as enterprises push specific applications and workloads into the cloud, their operating metrics get worse and worse inside their own data centers. And so the economics from an OpEx perspective of moving out improve. But the second piece comes back to what I was talking about on SDN, which is SDN is not going to come in and put a point of presence inside a dedicated enterprise facility. So they're actually critical resources the enterprises need to get a successful IT footprint out there that they can't access inside their own data centers. So OpEx, critical resources, they're going to drive enterprises to outsource more, and we actually think at an accelerated pace. The average footprint from each enterprise will likely shrink, but the aggregate demand from total enterprises we think will be much larger over the next several years.
Yeah, and it's one of the reasons I think that the user flexibility, you know, as the data center user has got more mature, flexibility has become so much more important because you don't know what the next several years will bring. You can plan to, you know, the best with what you know today, but, you know, tomorrow things change. And I think you know, I've said this before, but I think the data center operator community does a good job of listening to end users and figuring out the best they can within reason how to provide flexible solutions, not just from a overall space or power standpoint, but from the actual end user services they're bringing to the market, and really try to serve the user better. And one of the things I know it's important for enterprise users, but also for very large scale users is renewable energy. And I know that is, you know, and I don't know if this is in the last several weeks that I saw this, but I know that y'all recently announced that your London facility, I believe, would be 100% powered by renewable energy. And so, you know, as you all sit as one of the leaders in the space today, just talk about the importance of that for not just your customers, but you all as a company that's providing this infrastructure.
Yeah, and look, you know, to your point, this is an industry sort of push, not just CyrusOne. And I think on a personal level, I'm proud for our company and for the industry to be pushing more and more towards renewables, towards green energy. You know, taking a step back, today, data centers consume maybe 3 or 4% of global energy. Over the next 10 or 15 years, the numbers are pointing to north of a quarter of the global energy being consumed by data centers. This is not only a logistical problem in terms of the creation and delivery of power, but it's going to be a social problem too. That is, people are going to start asking the question over, does it make sense to be dedicating this much energy to this industry, creating this much output from a carbon perspective, et cetera, et cetera. And so the industry, and I think the customers themselves, thankfully, are driving the industry in this direction, are saying, let's solve those problems before they become sort of the social and logistical challenges that they will ultimately evolve into. So we do spend a lot of time exploring different ways of delivering critical power from green and renewable sources. You know, London was one where we were able to press forward, but I would expect us to continue to pursue whatever opportunities are out there, whether it's wind or solar, which are both renewable and green, or hydro, which is considered green but not renewable. But we're going to be looking for more efficient ways of delivering power to data centers and better ways to interact with the environment.
Yeah, no, that's great. So when you think about just the industry in general, we've talked about, you know, you've been in it a long time and now sit in a very strategic role. What gets you most excited about, you know, the next 5 to 10 years and how this space will evolve?
Well, look, without a doubt, the most exciting thing out there is artificial intelligence, as we talked about. So, you know, when you're asking me really to geek out, I'm geeking out on AI. But I would just say that, you know, we continue to see changes in network topology, in how customers interact with their IT resources, and how those come together, network topology and IT resource consumption and delivery, I guess, are changing the overall world. That is, data centers at the heart are real estate. And when you talk about real estate, you're talking about, generally people tell you, hey, physical real estate, location, location, location. In the data center world, that's true as well. But it's not just physical location, it's logical location. That is, where do you live on the internet? And when we talk about 5G and changing network topologies and software-defined networking and hyperscale network overbuild, which is a topic we didn't cover in great detail today, but it's critically important. You know, hyperscalers spend more on network investment in a year than the aggregate of all of the carriers in the world. That was an inflection in 2017. So you've got a lot going on from a network topology perspective. And then, as we talked about at the beginning of our conversation, the way that services are delivered and consumed, all of that means that those important logical locations are changing. And what we're playing for here at CyrusOne is to make those important logical locations of the future live inside our data centers.
Yeah, that's good. That's good. Well, Jonathan, thank you so much for your insight. And this is probably one of my favorite discussions we've had on the market, and what changes are happening today and what changes will come. So certainly appreciate your perspective and look forward to catching up with you on the next one.
David, this was a pleasure. Thank you so much.
You bet.